Good afternoon and welcome to today's webinar. My name is Nikita Emery and I'm thrilled to have the opportunity to share with all of you today. Today's webinar, we will focus on corporate tax in the UAE, and we've gathered a panel of experts who will be sharing their insights and experiences on this exciting and relevant subject. There will be an opportunity for a 5-minute Q&A at the end of the session. Today's webinar, we will likely introduce our first TA, JAXA Joseph, who is a fellow member of the Institute of Chartered Accountants of India. Mr. JAXA is a founding partner of JAXA and has gained expertise in auditing, finance, taxation, and company formation procedures in the UAE. Next, we will be introducing CA Jibby Joseph, who's one of the founding partners of JAXA Chartered Accountants. He's a fellow member of the Institute of Chartered Accountants of India and has extensive experience in the UAE in areas of audit and assurance services and tax-related matters. He has been practicing in the UAE from 2002 and onwards, through which he has been able to gain extensive knowledge about the UAE's economy and accounting and audit practices followed in the country. Finally, we would like to introduce Mr. Sambu, who joined JAXA in 2012. He is a tax expert who is actively involved with assisting clients with their VAT-related compliances and its introduction back in 2018. Now we will proceed to begin with our presentation, and our speakers will explain the basic provisions of the UAE Corporate Tax Law as published by the Ministry. We understand the value of your time, and we have designed this webinar to be informative. Our goal is to provide you with a comprehensive understanding of corporate tax and to give you practical insights that will apply to your work. So sit back, relax, and let's get started. I cannot wait to hear from our panelists today and engage in meaningful discussions with all of you. Thank you for joining us today, and I hope that you have a great time.
Okay, good afternoon, attendees. We all are waiting eagerly to know more about the contents of corporate tax. In today's webcast, we will cover some major key areas for the same. And if you have any questions or queries, put it on your chat box. At the end of the section, we will address for that one. When will the UAE corporate tax become effective? In December 9, 2022, UAE released corporate tax to the general public, even though it was issued in the official gazette on October 3rd and will be effective within 15 days. UAE corporate tax regime will become effective for a financial year starting on or after June 1st, 2023. For example, financial year starting on June 1st, then corporate tax applicable from June 1st, 2023. For a company is financially starting on January 1st, then its applicability is coming from January 1, 2024. And the same scenario, it is on April 1st, then in April 1st, 2024. Who is subject to corporate tax? Broadly saying, taxable person. Who is a taxable person? Taxable person shall either a resident person or a non-resident person. Who is non-resident person? Resident person. A juridical person that is incorporated under the applicable legislation of the state, including a free zone. A limited liability LLC company formatted in mainland under the mainland legislation or from a free zone regulation comes under this category. The second scenario, a juridical person that is incorporated under the applicable legislation of a foreign jurisdiction that is effectively managed and controlled the state. For example, a company is incorporated in UK or US or in Cayman Islands, whatever, wherever. But if it is effectively managed and controlled in UAE, then that person comes under the resident person category. Third one, a natural person who conducts business or business activity in the state. The law defines business activity, any activity conducted regularly on an ongoing, on an independent basis by any person and in any location, such as it may be industrial, commercial, professional, agricultural, and any other activities related to the use of tangible or intangible properties. And business activity means a transaction or activity or a series of transaction or series of business activity conducted by a person in the course of its business. And for example, a natural person under the employment contract comes under does not come under the scope of UAE Corporate Tax. The last category, any other person as may be determined in a decision issued by the cabinet at the suggestion of the minister. Who is non-resident person? Regarding the taxability of resident person, they will be liable to tax on global income, that is income sourced from the UAE or from abroad. Although certain income earned through foreign subsidiaries and income from foreign branches that is subject to tax in another jurisdiction will be generally exempt from UAE corporate tax subject to some conditions. Also, income is earned from abroad is not exempt. We can make a relief for the tax payment of UAE corporate tax against the tax paid on foreign jurisdiction. Who is non-resident person? A non-resident person is a person who is not considered as resident and that either has a permanent establishment in the state as defined under the Article 14 or derived state-sourced income under the Article 13 of UAE Corporate Tax. And the third one has a nexus to the state as specified in a decision issued by the cabinet at the suggestion of the minister. What is permanent establishment? The law says permanent establishment in the state in any of the following some instance where it has a fixed or permanent place, a permanent place like it may be a branch, an office or a workshop, whatever the law says. The second one, where a person has and habitually exercise the authority to conduct a business or business activity in the state on behalf of a resident person. Third one, where it has any other form of nexus in the state as explained by the minister. Then the taxability of non-resident person. Non-resident person will apply only subject to UAE corporate tax on income from their permanent establishment or income sourced in the UAE subject to a 0% withholding tax. What is the corporate tax rates? Normally for individual and juridical person, 0% for taxable income up to and including AED 375,000. 9% of taxable income exceeding AED 375,000. For example, a company has a taxable income of 400,000. It would liable to pay tax on AED 25,000 only. That is 400,000 minus 375,000. Coming to the qualifying free zone person, 0% on qualifying income, 9% of 9% taxable income that does not meet the qualifying income definition. We should wait for the ministerial decision. What is 9% taxable qualifying income? Apart from this one, in addition to 0% taxable income up to and including AED 375,000, small business with the revenue a certain threshold even can claim small business relief and can be treated as have no taxable income during the relevant period and may be subject to simplified compliance obligation. Again, the same in this case, we should wait for the threshold limit, the ministerial decision, and also should wait for what is the simplified tax obligation will given to small business relief. Tax period. The tax period will be normally the Gregorian calendar, that is from January 1st to December 31st. If a company follows another financial year, they can use the same one, and if they want to change the financial period, they can change that one also. Branches. Is branches considered as a separate judicial person? The answer is no. The UAE branches of domestic or foreign judicial person just an extension of their parent or head office and therefore not considered as a separate judicial person. Therefore, in the income derived from branches should be included in the taxable income of their parent or head office. Note that no separate registration will be allowed for branches. Taxable income. The accounting net profit or business based on the financial statement prepared by the company after making certain adjustment for certain items as defined in the corporate tax law. In the financial statement, we can prepare the financial statement based on general accepted accounting standard of the UAE. In UAE, normally all the companies are following international financial reporting standard. We can follow that one also. For deriving the taxable income, the laws allow some adjustment for that one. The first adjustment is that one for unrealized gain or loss, that will be explained in the next slide. And exempt income such as dividend, that one also we explain. Relief for intra-group transfers and business restructuring. The fourth category, deduction which are not allowable for tax purpose. And the law says that some expenses we cannot deduct. And the fifth one, adjustment for transaction with a related party and connected person. That means subject to arm's length price and transfer price policy. Last one, tax losses carried forward from previous years. And last one, any other adjustment are specified by the minister. For unrealized gain or loss, we have the law provides two options. Option one, the taxpayer can elect to recognize gain or loss on realization basis for it or asset and liabilities. Under option two, for asset and liabilities held on capital account only on realization basis. If it is asset and liabilities held on revenue account, unrealized gain or loss will be taxable income or deductible expense at the end of that period. Means if you are provision creating for an expected loss, credit loss, we can treat it the same period that itself. It is an allowable deduction. Some examples of capital assets include property and equipment, investment, loan, or etc. And the same like capital liabilities includes loan, non-current liabilities, and other liabilities not connected with the revenue and expenses. Corporate tax law also exempts certain types of income from corporate tax and will not be subject to corporate tax. The first one is dividend and other profit distribution derived from UAE incorporated or resident legal person. They are already taxed at their hands, so they are exempt for the tax computation of taxable. Dividend and other profit distribution received from a participating interest in a foreign juridical person. For participating interest, the law says some condition. We should follow that condition and fulfill the conditions for that one also. The third one, certain other income like capital asset, foreign exchange losses, and impairment gain or losses from a participating interest. The fourth one, income from a foreign branch or a permanent establishment where an election is made to claim in the foreign permanent establishment exemption. Lastly, income earned by non-resident from the operation or leasing of aircrafts or ships in international transportation where certain conditions are met. The law allows some deductible expenses, says about deductible expenses. All the expenses incurred in connection with to derive the taxable income, we can deduct. But it should be dependent, although the timing of deduction may be vary for different types of expenses and the accounting method we are using. And we cannot deduct the expenditure incurred in connection with for deriving exempt income. For capital asset like property and equipment and other, we can deduct by a way of depreciation or amortization over the economic life of the asset or benefit. Expenditure that has a dual purpose means, for example, a company is providing mobile connection or vehicle to the employee. Such expenses can incur for both personal and business purposes. We will need to apportion in the relevant portion of the expenditure treated as incurred wholly or exclusively for the purpose of taxable person business. With this, I am just handovering to Mr. G.V. Joseph to continue the next session.
So, the lawmakers, as Jisho pointed out before, all legitimate business expense can be deducted when you compute the taxable income. But lawmakers know that there will be confusions on certain expenses, whether it is business, whether it is for business or whether it is not related to business. So the law has identified certain expenses. The first one is donations, grants, or gifts made to an entity that is not a qualifying public benefit entity. A qualifying public benefit entity is normally an approved charitable organization like Emirates Red Crescent Society and so on. So if you make any donation or grants or gifts to those organizations, then you can deduct, otherwise it cannot be deducted. Fines and penalties. But if the fines and penalties are awarded as compensation for damages or breach of contract, then again it can be deducted. Fines like filing the late filing of VAT returns, late payment of VAT amount, etc., that cannot be deducted. Bribes or other illicit payments, it's very natural. And next one is dividends, profit distributions, or benefits of a similar nature paid to an owner of the taxable persons, because it is not an expense, it is merely a profit distribution. And again, amount withdrawn from the business by a natural person who conducts a business or a partner in an unincorporated partnership. Another non-deductible expense is corporate tax, which is not an expense, again, it's a government fee. And input VAT incurred by a taxable person, that is recoverable as per VAT laws. So the law says that any input VAT incurred by a company which was supposed to be recovered, then that also cannot be claimed as an expense. Then tax on income imposed on the taxable person outside the state. For example, if your company has a branch outside UAE and the income of that branch was subject to tax in that country, then that tax is not an expense for you, but you can deduct that amount from your corporate tax liability in UAE subject to certain conditions and caps. If it is not possible to reduce from your tax liability, then again, it is not a company's expense. It needs to be adjusted when you compare the taxable income. And as we see in most of the clauses, any other expenses are specified in a cabinet decision on a later date. And for certain expenses, law has given a relief that you can claim, but subject to some limitations or caps. One such is entertainment expenses. Taxable person shall be allowed to deduct only 50% of any entertainment, amusement, or recreation expenditure incurred for the company. This applies to any expenditure incurred for the purpose of receiving and entertaining the taxable person's customers, shareholders, suppliers, or other business partners, including but not limited to expenditure in connection with any of the following. So law has given some inclusive list. This is not an exhaustive list. They have given some examples or any similar expenses which are in the nature of entertainment. You can claim only 50%. The law has given examples as meals, accommodation, transportation, admission fee, facilities and equipment used in connection with such entertainment, amusement, or recreation, and other such expenditure as specified by the minister later on. Here, one point to note is that they have omitted the staff from the list of people who will receive the entertainment. If you remember in VAT law, actually they have specifically included staff, and they had mentioned that any entertainment expenses incurred on staff also, you cannot claim the input VAT. But maybe there are two ways on that one. If you consider the laws of other jurisdictions, normally staff entertainment is considered as a normal business expense, and hence we can claim 100%. That is one view. And so another view is that this other business partners, it has a vast meaning and it includes staff. We need to wait for a clarification from the tax authority or minister on this one. Surely they will issue something, we believe. And another type of expenses which has a cap is interest expenses. The law has put some restrictions on the deductibility of interest expenditure for two reasons. One is to discourage excessive debt financing by any companies. And second is to ensure that debt financing used or arising as a result of certain specific related party transactions will only be deductible if there is a valid commercial reason for obtaining the loan. Because let us see what are those limited interest deduction limitation rules. There are two rules. One is general interest deduction limitation rule. This applies to all companies. Okay, business with net interest expenditure above a threshold. This threshold they have not mentioned up to now, will be allowed to deduct net interest expenditure up to 30% of their EBITDA, excluding any exempt income. Any net interest expenditure which exceeds this limit may be carried forward and utilized in the subsequent tax period. So it is not blanket disallowance, you can carry forward and use it for next 10 tax periods. Here we need to understand two things. One is net interest. What is net interest expenditure? Net interest expenditure is the net of your interest expenditure and your interest income. So if you have both interest expenditure and also you are earning interest income, then you should net it off and then compare with the 30% of your EBITDA. And also a threshold. This threshold, law has not mentioned what is a threshold. So if, for example, if they put a threshold of 100,000, so your net interest expenditure up to 100,000, you can claim it fully. If it exceeds 100,000, suppose if the threshold is 100,000, if it exceeds 100,000, then only this 30% cap would be applicable. And this general interest deduction limitation rule is not applicable for banks and other financial institutions whose main business is like receiving interest income, etc., insurance providers, and even for individual business owners. And then comes the specific interest deduction limitation rule. This is to control certain type of related party transactions. No deduction shall be allowed for interest expenditure incurred on a loan obtained directly or indirectly from a related party in respect of any of the following transactions: a dividend or profit distribution to a related party, a redemption, repurchase, reduction or return of share capital to a related party, a capital contribution to a related party, the acquisition of an ownership interest in a person who is or becomes a related party following the acquisition. This is where a company gives some amount to its related party by way of dividend or repurchase of share capital or capital contribution, and then receive it back in the form of loan, saying that, okay, the company does not have enough cash flow for its working capital. Then law sees that the law sees that it may not be a genuine business transaction. It is done with an intention to reduce the taxable income, and hence any interest expenditure on similar kind of transactions will not be allowed. It will be completely disallowed when you compute the taxable income. The interest on the related party loan will not be deductible unless the taxpayer can demonstrate that the main purpose of obtaining the loan and carrying out the transaction is not to gain a corporate tax advantage. This means that if the company is able to prove that this transaction was genuine and it was necessary to carry out the business, then again it will be allowed. And also there is one more condition, like if the other party is also subject to corporate tax in UAE, or even if it is they are incorporated outside UAE and in that country, if the other party is paying interest not less than 9%, then still this clause will not be applicable. Now, another adjustment which we need to make on accounting profit is for transfer pricing, where you have transaction with a related party or a connected person. Let us understand what is this arm's length principle and transfer pricing. Transfer pricing rule seeks to ensure that transactions between related parties are carried out on arm's length terms as if the transaction was carried out between independent party. So if you do a transaction with a related party, you need to make sure that transaction is recorded at the same consideration if you are dealing with a third party for the same similar services. To prevent the manipulation of taxable income, various articles in the corporate tax law requires that the consideration of transactions with related parties and connected person needs to be determined by reference to their market value. Market value means the value at which you should have dealt with a third party for same type of service or supply of goods. See, if you go through the law, there are 70 articles in the corporate tax law which was issued in December, out of which 7 articles covers arm's length principle and transfer pricing. So this aspect is going to be very important in the coming corporate tax regime. As we all know, UAE is well known for accommodating a lot of multinational companies, and there are companies who has a lot of related party transactions within UAE and outside UAE. So this particular aspect is going to be very critical when corporate tax is introduced. And transfer pricing rules apply to UAE business that are transaction with related parties and connected persons, irrespective of whether the related party or connected persons are located in the UAE mainland, a free zone, or in a foreign jurisdiction. And transfer pricing rules will apply to all transactions with the related party and connected persons. Hence, even a loan obtained from or granted to a related party and connected persons needs to be at arm's length. You cannot determine or decide the terms and conditions of any kind of transactions with a related party as you wish. You need to follow the regulations of corporate tax law. Now let us understand who are related party and connected persons. The Article 35 of the decree law defines the term related party. A related party is an individual or entity who has a pre-existing relationship. That means relation should be pre-existing with a business that is within the scope of UAE corporate tax regime through ownership, control, or kinship. There are three ways of establishing a relationship. It can be through ownership, control, or kinship. Kinship is in the case of natural persons. And the decree law has specified some situations where the parties involved will be treated as a related party. Let us go through one by one situations. The first one is regarding individuals. Two or more individuals related to fourth degree of kinship or affiliation, including adoption or guardianship. Presenter, can you go to next slide where we have created a chart for easy understanding. So we have colored the various degrees in different colors, so it will be easy to identify. So for an individual, for in the upward direction, parents will be their first degree relative, followed by grandparents, great grandparents, and great grandparents will be the fourth degree relative, down children, and up to great grandchildren. On sideways you can see that brothers and sisters will become second degree relative, and it will fourth degree relative. In that route will be great nieces and nephews. This is for kinship relation table. Another one is affiliation. Affiliation can have a very vast meaning. Normally, in other countries, they are clearly mentioning it as spouse, etc. Here, they have they have introduced the word affiliation, which can have wider meaning, like even living together partners will also be considered as related party. Okay, the second type is two or more legal entities, where one legal entity alone or together with a related party directly or indirectly owns greater than or equal to 50% or controls the other legal entity. So in this case, one legal entity along with the related party will either hold 50% or more of the share capital of the company or controls the other legal entity. A third type is a person and its permanent establishment or a foreign permanent establishment. Okay, and the fourth one is an individual and a legal entity, where the individual alone or together with the related party directly or indirectly owns 50% or more of the ownership in that company or controls the other legal entity. This is a case where one is individual and the other is a legal entity. Now again, two or more legal entities, if a person alone or with a related party directly or indirectly owns a 50% share of each or controls them. This is like common shareholding. As an individual, if he is holding 50% or more of share capital in two companies, then those two companies will be related parties. And another one is partners in the same unincorporated partnership, and also trustee, founder, settler, or beneficiary of trust foundation and its related parties. Now let us see what is control. We saw it in almost everywhere they use the term control in addition to ownership. So control for determining related parties as follows. One is the ability to exercise 50% or more of the voting rights of another person, determine the composition of 50% or more of the board of directors of another person, receive 50% of more of the profits of another person, determine or exercise significant influence over on the conduct of the business and affairs of another person. Let us discuss one peculiar situation in UAE. As we all know, until recently, for making an LLC company in mainland, there was a requirement to have a UAE national shareholder with minimum 51% share capital. So a UAE national was there as share capital, but he was like a nominee shareholder only, and we normally call it them as sponsor. There could be agreements where it will be mentioned that the UAE national will not have any role in the company, he will not receive any profit share, etc. But still, by virtue of law, he will have more than 51% of voting rights, and he will also be a related person. Then the second question will come: an expatriate shareholder, he has only 49% shareholding. So whether he will be a related party? Yes, of course, because if you look at the fourth condition of control, normally the expatriate shareholder is the person who conduct the business regularly and who exercise significant influence over the business. So he also will be a related party. Now the UAE has introduced one unique concept called connected person, which is specific to UAE. Why it is only specific to UAE? Because we know there is no personal income tax in UAE, and tax authority understand that people will take a route to pay more to the shareholders or directors of the company to reduce the corporate tax amount, corporate tax, and hence they want to control the payment made to a connected person. And to see who are the connected persons, the Article 36 of the Decree Law defines the term connected person. Okay, it could be an individual who directly or indirectly has an ownership interest in or controls the taxable person. Second type, a director or officer of the taxable person. Please note, it was even mentioned officer, where the taxable person is a partner in an unincorporated partnership, any other partner in the same partnership, and a related party of any of the three. So, as I said, even they have mentioned the officer, so it could be an even employee of the company also. In Article 36, the law says that any payment or benefit made to a connected person should correspond with the market value of the services provided by them and should be incurred wholly and exclusively for the purpose of taxable person's business. So if you make a managerial remuneration or salary to your company's owner or director and even an employee, then you should make sure that it corresponds with the market value of the services provided by similar persons in another company. They are not given an indication what will be the market value. In some countries, it is linked to percentage of profit. In some cases, even in the previous company law in UAE, if you see in most of the memorandum, we could see that there was a clause, the manager is allowed to take salary up to 5% of profit, and in some cases we are even seen that it is linked to the turnover of the company also. So like that, we expect that the ministry will issue some notification at a later stage indicating what could be the market value of the various services. We believe so because in Oman we understand there is such a document. We need to wait for further clarification. Another adjustment which needs to be made in accounting profit to arrive at taxable income is tax loss. The law identifies that a company may incur losses in some years. It may not be profitable every year. So in that case, if you compare over a period of time, the company may be paying more taxes than their income over a period of time. Like if you compare 10 years, in that 5 year was profit and 5 year was loss. And if you compare the overall profitability of 10 years, then if you compute tax on profits of income of the profitable years, then you may be paying more income over a period. So the law is giving some relief for the tax laws. The law defines tax loss as a loss which arise when the total deductions, total legitimate deductions a business can claim is greater than the total income that is subject to tax for the relevant tax period, resulting in a taxable income, negative taxable income. So the law says that tax losses can, but subject to certain conditions, can be offset against the taxable income of future periods up to a maximum of 75% of taxable income in each of those future periods. So you can carry forward the tax loss and can offset against the taxable income of any future period. There is no time limit mentioned. You can carry forward it indefinitely and adjust against any year's profit. But there are some conditions which we will discuss in ongoing, I mean, in the coming webinars, because there are so many conditions, it will take long time. But we will say some conditions in the next slide. For example, I mean, just to give an example, a taxpayer has a taxable income of 500,000 in the current year and carry forward loss of 600,000 from the previous years. It can offset 75% of current year's income. That means ID 500,000 into 75%, which is 375,000 of its losses carried forward with the taxable income of the current period, reducing the taxable income to 125,000. 500,000 minus 375,000. So the taxable income will be 125,000. And the amount of tax losses available for carry forward after the adjustment will be 225,000. 600,000 was the carried forward loss. We use 375,000 during the year and balance is 225,000. One of the major condition is that the same person or persons should continue to own at least 50% of the entity with the losses. So there should not be any change in shareholding in the coming periods. But law also says that even if there is a change in ownership, still you may be eligible to offset the tax losses, provided there is no major change in the nature or conduct of the entity's business. Okay, now this is an interesting topic and many of you will be eagerly waiting to hear about this one. To be open, the law has very few articles related to free zones. In public consultation document, they had given more information, but when they issued the law, they have limited the information to very few. Actually, only 4 clauses are there in the law. And they have introduced 2 new terms called qualifying free zone person and qualifying income. So let us understand what is a qualifying free zone person. So to be qualified as to be treated as qualifying free zone persons, a free zone company must meet certain conditions. First is to maintain adequate substance in the state. Second is derive qualifying income as specified in the cabinet decision, comply with transfer pricing rules and maintain the relevant transfer pricing documentation, and should not have made an election to be subject to corporate tax in full. So a free zone company can have an option to elect to become a normal taxable person, like they will pay 9% taxable income like a mainland company. So first, they should not elect for that one. Second one, they should maintain adequate substance. This is going to be very critical. The law says that maintain adequate substance in the state. But if you see most of the free zone regulations, they say that the business must be conducted within the free zone area. So indirectly, the free zone persons may be required to maintain adequate substance in the free zone itself. The law has not defined what is adequate substance. But if you refer the various clauses in economic substance regulations, which was issued in 2019, and as most of you may be aware about it one, it says that there are to be able to prove that there are adequate substance, certain conditions to be fulfilled. One is for income generating activity should be carried out in the state. You should have enough you should have enough resources within UAE in the form of assets, employees, etc. The key management decisions are taken within the state. Management and control is done from the UAE, etc. So That means a free zone person should have enough staff, enough office space. Maybe for small companies, they will accept this what we call flexi offices, etc. But if the turnover is really high, they may ask for maybe physical offices. Then you should have adequate staff to support your operations. The key management decisions should be taken within the state. Board meetings should be conducted within the state in physical form, etc. And also law says that they should be deriving qualified income. But unfortunately, law has not defined what is a qualified income. We need to wait for the cabinet decision to clarify what is qualified income. But if we go back to the public consultation document issued in April 2022, it says that you will be imposing 0% on corporate 0% corporate tax on free zone companies, provided they will not earn any income from UAE. So we believe that qualified income will be an income which is earned from outside UAE or within free zones in UAE. So the law says that qualifying free zone persons will be subject to UAE corporate tax at the following rates: 0% on qualifying income and 9% of income which is not counted as qualifying income. As I said, qualifying free zone person can elect not to apply the free zone incentive, but rather they will elect to become a normal taxable person and pay 9%. The law is not very specific regarding the revocability of the elections once made. If you read the current law, it suggests that you can change the decisions at any time before the start of a financial year. But in public consultation document, it was clearly mentioned that the decision will be irrevocable. Means once you make a decision, it cannot be changed at any later stage. But it was too harsh. That is why we believe that they are not included many clauses which was there in public consultation document. They may be studying or thinking about this one in deep, and we expect that they will be issuing a detailed cabinet decision on free zones very soon. And let us see what are the other rules for free zones. All free zones in entity will be required to register and file a corporate tax return, irrespective of whether they are a qualifying free zone person or not. Still, we are getting a lot of questions, or a lot of people are still saying that, okay, I am a free zone person, I am exempt from corporate tax. First of all, everyone should understand that free zone person is as good as a mainland company for corporate tax purpose. They are given some incentive to promote the free zone companies, because the UAE or free zone various free zone authorities has already committed to companies that they will be giving 50 years tax incentive, etc. So the UAE government also wants to honor such kind of promises already given. So they are given a relief or incentive only. That does not mean that they are outside the UAE corporate tax scope. They need to register and file corporate tax return every year. That is, there is no doubt on that one. And they need to follow all other regulations like keeping books of accounts, etc. And another question is that, like in VAT, there are designated free zones and non-designated free zones. So many people from designated free zones is asking whether we will have other relief, same like VAT. No, all free zones will be same. All free zones will be considered same for corporate tax purpose. Again, qualifying free zone entities that are part of large multinational groups could be subject to a corporate tax rate once the Pillar 2 rules are embedded into the UAE corporate tax regime. The Pillar 2 rules from OECD, the discussions are going on. Sooner or later, UAE has to be part of that one. And once that is introduced, even a qualifying free zone person, which could have been subject to 0% tax, will have to pay a tax rate of 15%. That is the minimum rate for large multinational groups prescribed by the Pillar 2 rules. Will have to pay 15% tax. This is, there is no clarity up to now when it will be implemented, but later on at any point it can come. As I said, qualifying income is properly not defined, so we need to wait for clarification from ministry or notification from ministry for this one. The next one, the last slide which I will be covering is regarding tax credit. The law has identified two credits which you can make to your corporate tax liability, not to the income. It is not that these adjustments are to be made after computing your corporate tax liability. One is withholding tax. Withholding tax incurred by a non-resident person for their state source income. For example, a foreign company earns some income within UAE. UAE company may deduct withholding tax while making the payment to them. Currently, the 0% is the withholding tax applicable at the moment. Once it is increased to say 5% or 9%, as per the rules of almost all corporate tax laws in other jurisdictions, the resident person will have to deduct withholding tax and pay that amount to the government. But when this resident person, when they if they have permanent establishment, they need to register for corporate tax, and when they submit their corporate tax return, they can claim this as credit, the amount already deducted by the resident person. Then the second credit is foreign tax paid. As we said, for a local company, for their permanent establishments outside UAE, that also needs to be clubbed with the income of UAE company, their parent company. Like a UAE company, if they have branch outside UAE, the law says that that branch's income also should be included. But if that branch's income is subject to corporate tax in another jurisdiction, law gives an option to claim the tax credit which they already paid in another foreign country. But it should not be higher than the it should not be the amount the credit what you take should not be higher, should not be more than the amount which you should have paid here. Like it should not be 9% of the profit of that branch. Any excess foreign tax credit cannot be carried forward or backdated to a different tax period. Now we have more to hear about grouping of different companies. What are the financial records to be kept and administrative procedure? Let me invite Mr. Shambhu to continue the presentation.
Thank you, sir. And today, as Mr. GB has already mentioned, I will be covering topics such as tax groups, financial records and books of accounts to be maintained, administrative requirements, and also regarding the transitional provisions. Now, if you start with the tax group, UAE company can apply to the Federal Tax Authority for registering themselves as a tax group. Once you are registered as a tax group, you will be treated as a single taxable person. So if a UAE parent company directly or indirectly holds at least 95% of the share capital, have 95% or more voting rights, and is entitled to 95% or more shares, profit share of the company, you can form a tax group. This is one of the conditions which FTA has put out. Now, in the given example, company A owns 100% in company C, and company C owns 80% in company B. Company A owns 20% also in company B. So since company A indirectly owns 100% of shares of the company B via company C, it can form a tax group with both company B and company C. Now, to form a tax group, FTA has laid out that neither the parent company nor any of its subsidiaries can be an exempt person. We have already covered what is an exempt person, and those companies should not be a free zone entity benefiting from a 0% corporate tax rate. Also, all the companies within the group should follow the same financial year and also prepare the financial statements using the same accounting standards. So you cannot use different financial periods, financial years, and also use different financial accounting standards. Now, the next question arises whether a subsidiaries of a foreign parent company can be part of a group. Now, in a US scenario, you can have, you may know that, okay, many foreign companies will be having subsidiaries in UAE. So these companies cannot form a tax group because their parent company is located outside UAE. However, if UAE subsidiaries are held by an intermediary UAE company, and that company can become the parent company, and then they can form a tax group. Now, there may be a question whether a foreign entity can be formed part of a tax group. The answer is no. But law states that if the foreign company is managed and controlled in UAE and is considered as a UAE resident entity for a UAE corporate tax purposes. We have already mentioned the permanent establishment category earlier in our slides. So if they are considered as a taxable, if the foreign entity is considered as a taxable person for UAE corporate tax purposes, then even the foreign entity can form part of the taxable group. Now, regarding the threshold, this is something which you have to be more careful, because the threshold of 375,000 will be eligible for the entire tax group, since tax group is considered as a single taxpayer. Say that if you have 10 companies in the group, you will not get benefit of 375 each for all the 10 companies. Since it's a single taxpayer, you will get the benefit of 375,000 for the entire group. So this is something which you have to decide before you take a decision whether to form a group or not. Because if you are in a separate, if you are forming as separate, if you are registering as a separate company, you can take the benefit of 375,000 for all the companies. Now, if you are becoming a tax group, you can net off only this 375,000. So that is something which you have to decide before taking a decision on whether to form a tax group. Now, there may be a question as to who will be responsible for filing the UAE corporate tax return and for payment of the UAE corporate tax. So since the tax group is represented by the parent company is actually responsible for the administration and payment of corporate tax, and that is on behalf of the group. Now, some may think that, okay, since they are registered as a tax group, whether the company has to be, or the tax group have to prepare consolidated financial statements. The answer is no, but to determine the taxable income of the group, the parent company will have to consolidate the financial statement of each subsidiaries, netting of all the transaction between the parent company and the subsidiary. However, each subsidiaries can maintain books of accounts separately, but use the same accounting standards. However, for the purpose of computation of taxable income, you are supposed to prepare consolidated financial statements. Now, we'll move on to the next portion, that is financial records. So what financial records are to be kept? So taxpayers are expected to prepare and maintain financial statement for the purpose of calculating their taxable income, and should maintain all documents and records that submit the information the corporate tax return submitted. So since most of the companies would have been already registered for VAT, you know that, okay, when you submit a VAT return, you are supposed to maintain proper records supporting the figures that is included in the VAT return. So when during the audit of FTA, they used to ask you to provide the supporting documents, the breakup of the figures submitted, and also the supporting documents against those transactions. But you have to keep in mind that corporate tax has a bigger scope, and it covers all the areas including the financial statement. So even if it's not subject to VAT, you have to keep supporting documents. Even for very small transactions also, you are supposed to keep supporting documents. And as an exempt person, if a company comes under the exempt person category, don't think that you are an exempt person and you are not supposed to maintain any record. Even exempt persons are required to maintain all records to support your exempt status. Now, regarding the documentation, how long you have to keep the records? The law says that you have to maintain the books of accounts, records, supporting documents for at least 7 years following the end of the tax period. Similar to that, you will be allowed to maintain documents either as soft copy or hard copy, but this is not specifically mentioned, but they may allow both the methods for keeping the supporting documents. Now, another eager question is whether you need to do the audit. So what law states is that only categories of taxable persons that are listed in the decisions issued by the minister will be required to prepare and maintain audited certified financial statements. So this list has not been published yet. However, in the public consultation document that was issued in April 2022, they are specifically mentioned that all the free zone companies would be required to do the audit. As of now in the law, it is not stated as such, but we will have to wait until we receive a list from the minister regarding this. Now, regarding the submission of financial statement to tax authority, FTA is not insisting for the financial statement to be submitted along with the corporate tax return, but the financial statement has to be provided upon request by the authority. So this is similar to other jurisdictions as well. When you submit the VAT return, you are just disclosing the taxable income along with some adjustments. But in case for their scrutiny or for their verification purpose, they can ask you to provide financial statement, and that may include audit report also. But we'll have to wait until we receive a cabinet decision. Now, regarding the currency. Regarding currency, you have to be more careful because for calculation, what law states is that for calculation of corporate tax payable, all amounts must be quantified in AED. And any amount quantified in any other currency must be translated at the exchange rate set out by the central bank. And everyone knows that UAE Central Bank is publishing the exchange rates to be followed in their website. In the FAQ, now here it is not clear whether we have to translate all the transactions at the applicable exchange rate or only the closing balances or the final P&L account at the closing exchange rate, applicable exchange rate. Now, in a FAQ published by the ministry, they have specifically mentioned that all transactions should be translated in applicable exchange rate set out by the central bank. So there is a chance that after you submit, they may ask you to provide all the transaction in AED. So that will create a confusion in future. It will be difficult for you to convert all the transactions for many years to AED. So our suggestion is actually to keep the records in AED itself. Now, if we move to the administration requirements, as everyone know, UAE Corporate Tax is a self-assessment regime. So you have to compute how much is your taxable income. You have to assess the validity or accuracy of the financial records you have made, and you have to submit it to the authority. Now, all taxpayers, unless exempted, will be required to register for UAE Corporate Tax and obtain a corporate tax registration number. So all taxpayers, unless if they are exempted, will be required to register for corporate tax. Now, FTA has started accepting corporate tax registration, and if you go to the FTA portal, okay, if the company is already VAT registered, you can go to FTA portal and you can now itself you can see a tab for submitting the corporate tax registration. However, FTA has already informed that the corporate tax registration has to be done on an invitation basis only. So we'll have to wait until we receive an invitation from the tax authority for getting registered. And the taxpayers will be able to electronically register through the Emira Tax portal of the tax authority. Taxpayers are required to register before they file their first corporate tax return. So they are not mentioned that there is a deadline for getting registered for the corporate tax return. You have enough time, and you can wait. You have time until you submit your first corporate tax return, which will be due 9 months after the end of the financial year. So if your financial year starts from January 1 to December 2024, your first return submission will be on September 2025. So before September 25, you have to get the registration in corporate tax return and also have to submit the return and make the payment. There is no registration threshold which is mentioned in the corporate tax. So all companies, irrespective of whether you are below the threshold, whether you are incurring loss, you have to get registered. Now, taxpayers will be required to register for your. So many companies are asking queries whether I am already registered for VAT and I am already having a login with the Federal Tax Authority, and should I register separately for corporate tax? The answer is yes, since they have specifically mentioned that the registration has to be taken separately. So wait for the invitation from the authority. Once you receive that, you can get registered. And the law states that only one corporate tax return need to be submitted per tax period, and the corporate tax will be due within 9 months following the end of the tax period. This I have already taken. And then all tax persons are expected to file a corporate tax return irrespective of the level of income or the status of the company. So even if you are below 375,000, even if you are in free zone, even if you are having qualifying income, all these persons have to submit the corporate tax return. And now for companies with loss, you should ensure that you file the corporate tax return in order to ensure that these losses can be used to reduce taxable income. So as we have already mentioned, tax losses can be carried forward to be adjusted in future profit. So this will be a necessary. This will be necessary for tax authority may tell that it is must that you should submit the corporate tax return on time to get eligibility for deducting this in the future tax returns. Now, if the company meets the requirements to form a tax group and their application is approved, then a single UAE corporate tax return covering all the members of the tax group have to be submitted. So if you are a tax group, as we have already mentioned, you have a threshold limit of 375,000 only. And if your registration is approved, you can file a single corporate tax return. Now, if your application to form a tax group is rejected, you will have to submit a corporate tax return separately for each companies. Okay, you cannot still file a consolidated tax return. Now, corporate tax return have to be filed electronically, and further guidance on this is awaited. They have not specified in which format we have to submit, or that details is not available. Now, corporate tax have to be paid before 9 months before following the end of the relevant tax period, and further guidance on the approved payment method is actually awaited. Maybe we'll be having the same methods that we use for the payment of VAT, but since no details are available, we are not going to comment on that. Then your business will not be required to make advance payment. That is something you have to consider, because you don't want to make any advance payment. Okay? You can make the payment only after 9 months following the end of the relevant taxable period. So you have time around more than 2 years for making the payment against the corporate tax. And similar to other taxes in UAE, business will be subject to penalties for non-compliances with the UAE corporate tax regime. And further information on the penalties and applicable obligations is still awaited. So in the law, they have not mentioned what will be the obligation, what penalty you will face for any of the non-compliances. They are not specified anything as such as of now, but we will have a cabinet decision which specifies what all will be the penalties. Now, regarding the anti-abuse rules. So Article 50 of this law states that this article actually applies to transactions or an arrangement having regard to all relevant circumstances. It can be concluded that entering into a carrying out a transaction or agreement, it's not for a valid commercial or a non-physical reason which reflects economic reality, and the purpose of this arrangement is to obtain a corporate tax advantage. So any action or any tax planning that you are doing in order to get a tax benefit or a corporate tax benefit will be considered under this anti-abuse rules. Say that in some companies, some consultants would be advising you to not to charge depreciation or amortization during the current first financial year. Maybe in 2023, they are asking you not to charge amortization or depreciation and wait until 2024 once the tax period, once the law is implemented. And then during that period, you can charge depreciation so that your taxable income will come down and you will end up paying only less tax. So if you are planning something to do in your financial statement such that your taxable income get reduced, that will come under this anti-abuse rules, and you will be penalized. You are not supposed to do any such malpractice to reduce your taxable income. So anything that you do which ends up with having a corporate tax advantage will come under this purview. This is one of the transitional provisions which we'll be discussing in the next slide. Now, regarding the transitional rules, Article 61 mentions that opening balance sheet of the first tax period is the closing balance sheet of the financial year that ends immediately before the first tax period. And Article 61.2 says that the arm's length pricing has to be followed. So both these clauses, what they are mentioning is that the company, when preparing the financial statements for 2023, have to be very careful. They have to make sure that you comply with all the regulations that is already published for corporate tax. You have to mention that the company is using proper accounting standards, amortizing and depreciating all the assets properly, and all the related party transactions are done at arm's length price. And you have proper transfer pricing documentation also in place, substantiating the amounts that is included in the financial statements. So you have to make sure that you are not doing anything, as I mentioned earlier, you are not doing anything to get a corporate tax advantage. Now, we will just go through some of the requirements which your business need to take care when you are going to a new corporate tax regime. So first, you have to check whether your business falls under the exempt person category. So since we have already mentioned in our earlier slides, only a few companies comes under the exempt persons category. So first you have to identify whether you are a taxable person or an exempt person. And second thing, you have to identify what is your accounting and tax period. Now, we know that only a few free zones were having a mandatory requirement to submit an audited financial statement. So for those companies, you already know what will be your taxable period. Now, for those companies who does not have done the audit till now, and they don't know what is their accounting or tax period, they have to decide which tax period they fall into, because all their taxability, all their compliances will be based on the tax period they select. So they can go through their memorandum, they can go through the submissions that they have already made to the tax authority, stating this will be our taxable period. So you have to identify that. And by identifying the tax period, you will be able to know on which date you need to submit the corporate tax return. And then you will have to think what elections or applications you should make in your business for the corporate tax purpose. Like for a company who has a lot of assets, you have to see how much years you have to depreciate these assets, and you have to decide on what accounting standards you have to use. Okay, so you have to fix everything in the initial stage itself. And for your corporate tax, you have to see whether the obligations and liabilities under contracts with customers and suppliers. So you may be having some contracts with the customers and suppliers that may run from 2023 to 2025 like that. And there may be different stages of completion. There may be some milestones, payment, milestone, revenue recognition, milestone invoicing like that. So you have to understand your obligations and liabilities and have to clearly think when you have to recognize the revenue based on the contracts. So you go through all the contracts and obligations you have and understand when you have to recognize the revenue, when the cost has to be accrued, so that you report the proper taxable income once you are ready for the submission. And what financial information records your business need to keep for the UAE corporate tax. And if you are this financial information means we know that okay, many companies are having payments for which now if we ask okay, what documents you have for as a supporting for these payments, you said okay, we don't have any documents supported like that. But in a corporate tax perspective, you cannot tell to the tax authority that you are not having any supporting documents for substantiating any of the payments. So you have to make sure that you have adequate supporting documents, agreements, invoices, everything to substantiate to the tax authority that all the payments or expenses which is recorded or revenue which is recorded are correct. Now, if you are if you have more than one company, you have to decide whether you can form a tax group. And also, if you have related parties, you have to assess whether all the transaction between the related parties are done at arm's length price, and you have proper transfer pricing documentation in place. That's all from our side now, and we will now take some Q&A. Thank you.
Thank you so much, Mr. Sambujishu and Jibi, for your information and informative session. We will now proceed to our Q&A for the next 5 minutes.
Yep. I think there are a lot of questions regarding free zone. One such question is a free zone entity will have to pay income tax on income not derived from the Emirates. Again, the law is not very clear. We expect that any income earned by a free zone company outside UAE will not be subject to UAE corporate tax. They will be given a tax incentive like the tax. They will be subject to UAE corporate tax, but the rate will be 0%. We need to see what is the definition of qualified income. Based on the public consultation document, any income earned outside UAE will be part of qualified income and could be subject to 0% corporate tax. So another question is regarding amounts withdrawn from business by partner is a non-deductible expense according to your presentation. If the partner is actively working in the firm, can his salary be considered as deductible expense? See, if it is a proprietary business or unincorporated partnership or something, then only any amount withdrawn by a partner will not be allowed. If it is an LLC company or a company with a separate legal status, any payment made to the director or owner of the company can be claimed as an expense subject to meeting the transfer pricing or arm's length pricing criteria. There could be some cap. The law was not clearly mentioned what will be the restrictions, but we expect that a ministry decision will come for that one. And another interesting question: some VAT invoices does not mention our TRN, hence we were not claimed any input tax under VAT. The total amount treated as an expense. Can we claim that input tax and expense in corporate tax? What the law says that any input VAT which is recoverable. So in this case, since you are unable to recover as per law, because the suppliers, your TRN is not mentioned in the invoice, hence it was not recoverable, and hence you can claim it as an expense. This is what the plain reading of the law suggests. Again, a free zone question. Our company manufactures outside the UAE and sells to clients ours outside the UAE. I believe it is outside UAE. Thus, as far as I understand, our company is applicable to a 9%. All right. I think he is asking whether his company's income is subject to 9% tax or not. Again, with the details available, I believe that it would be considered as a qualified income and could be could be subject to 0% corporate tax, because the goods never comes to UAE. But this is not a confirmation. We need to wait for clarification from Minister. Is there a difference of taxation for its company? And we already discussed a lot. Also, please, is there a clear list of qualified income? Sorry, unfortunately, law has not mentioned anything about qualified income. Even they are not defined what is qualified income. So we cannot give any list, unfortunately. Can a free zone and made and connected together? I believe the question is asking whether they can form a group. The presenter already mentioned that if it is a qualified free zone person who is subject to 0% corporate tax, it cannot that cannot form part of a group, tax group. And another interesting question for shared services. I mean, if finance department, HR department is looking after UAE, Oman, and Qatar companies, then can salaries be claimed in full in UAE company, or how to distribute salaries to UAE, Oman, and other Qatar companies? It is very clear. You cannot claim full amount here. These are related party transactions. You should recharge it back to UAE, Oman, and Qatar companies by using appropriate transfer pricing. You cannot even just transfer it at cost also. You will have to make some markup also. Otherwise, it may not be accepted by the tax authorities. The question is, my company is registered in UAE and I am using it as a form of trading. I do not sell or gain profit from UAE. Is CT applicable for me? Unless you are in a free zone, unless you are a free zone company, I mean, if you are in mainland company, then even the income earned from outside UAE will be subject to UAE corporate tax. If you are in free zones, then you may get the incentive of 0% if you fulfill all conditions associated with it. Is there any fixed depreciation rate of fixed assets under UAE corporate tax? Until now, they have not mentioned anything like that. Most probably, they will allow companies to decide, but they cannot decide unilaterally. Like they need to follow some accounting standards like IFRS, etc. We don't know whether they will come up with a depreciation rate also. We need to wait. Whether a resident needs to pay tax on global income. So if an individual having business in UAE is resident in India, he needs to consolidate income from business in India and pay tax in UAE. I understand that an individual doing business will be deemed resident in UAE. Law is not clear. For an individual in his individual capacity, there is no need to consolidate his foreign business with the UAE business. Okay. And then there is a tricky, situation here. He is resident in India as per Indian laws, as far as I understand. If he is managing and controlling a foreign entity, then even that a foreign entity's income needs to be consolidated in India. In UAE, it will not need for consolidation. If he has, as an individual, he has some other business outside UAE. If the company in UAE invests or is a shareholder in a foreign company, or if they have branch office outside UAE, then only this needs to be consolidated. Impairment losses and gains, we already discussed in depth, I believe. Yes, the amount withdrawn as salary by company shareholder will be allowed for deduction, but subject to transfer pricing rules. We need to wait for, like, this is a payment to a connected person, so it needs you need to make sure that the payment corresponds with the market value of the services provided by him, and the amount is against a service which is incurred wholly and exclusively for the purpose of the company. If the shareholder has different companies, and if he takes salary from each and every company at a very high rate, it may not be allowed, because the law says that the services should be rendered exclusively for the purpose of the company. If you do service for many company, then it may not be allowed in any of the companies. Previous period tax losses cannot be carried forward and set against income earned during a corporate tax regime. Previous year's losses cannot be set off against future income. If one person owns more than one company, one is LLC and another one is normal business registration, so we need to group them or treated as individual business. For grouping, there are some conditions. Mainly, you should note that the grouping is possible for holding companies and its subsidiaries. Okay, common shareholding, etc., does not allow grouping. There should be a parent company, and it has many subsidiaries underneath that, which has in which 95% of ownership is held by the ultimate parent company through directly or indirectly through other subsidiaries. At least 95% of subsidiaries share capital is owned by parent company. Then only companies can be grouped. Common shareholding is not a criteria for grouping. You cannot group companies under common shareholding or cross-holding, etc. My company is a sole establishment, but not LLC. Whether we need to register as an LLC. If you are doing any business, definitely you need to register for corporate tax. Okay, each person doing business, whether it is incorporated or unincorporated, like I believe that you have a license, or you already is legally registered as a business, so there is no choice on you. But even if you are as an individual, you do some business without taking a legal permit to conduct business, even those cases are subject to corporate tax. What law says that, okay, you do business, I don't care, you report the tax, you report your income and pay the tax. After paying or after receiving the payment, okay, we will take necessary steps that you will not be allowed to do this illegal business. I mean, it will be reported to concerned authorities, and you will be getting other punishments. See, the law says that if you are a incorporated company, then you need to register for VAT. Whether you are earning any income is not the criteria, because there is a question I want to ask: will the company have to apply for CT if it has been registered but not trading asset? So even for a dormant company, if you have a license to do business within UAE, then automatically you are bound to register for UAE corporate tax. Is there an approved transfer pricing database approved by FTA? No, up to now, they have not come up with something like that. We expect that they will give some benchmarks because in all other jurisdictions, the authority used to give some benchmark references which companies can use. If rental income from investment property is taxable, if it is not a business, then it will not be taxable. If it is part of your business, then it will be subject to tax. Presence in mainland community of a local sponsor, does it bring any tax relief? Up to now, I mean, they have not come up with any such release. We don't expect such a release. We know that in some other countries like Saudi, etc., there are some release, but we, I mean, as per, until now, there is no such provisions in the UAE Corporate Tax law. Director's taking salary, it is already explained many times, I think. And is there any difference between accounting income and taxable income? This was clearly mentioned. I think half of the presentation was regarding that one. You need to make certain adjustments on your accounting to arrive at the taxable income, like adjustment for deductible, non-deductible expenses, exempt income, unrealized gain or losses, tax losses carried forward from previous period, etc. After making these adjustments only, you will arrive at the taxable income. Can you please confirm that we will receive an invitation to file the tax? It is purely in the hands of tax authority. What we understand is that it is now they are in a testing phase. They have invited very few companies to start their CT registration. It could be a test phase, and once everything is okay, then they will allow general public to do the CT registration. See, if you are forming a subsidiary in India, if it is a subsidiary, then it is a separate legal entity. That subsidiary's income need not be clubbed here. Only the dividend income could be included, but again, it is an exempt income. Our company is registered in Freezone, but still don't have corporate bank account for company. Just open bank account under the name of CEO. Is this subject to taxation? See, as I said again, it does not. The registration is not linked to the income of the company. Okay, if even once you are registered, you are a taxable person, and you need to register for VAT. I think we need to conclude the unanswered questions. We will be answering you through emails.
Yeah. Good afternoon, everyone. We thank you for taking our time to attend our webinar with us. Missed your busy schedule, so we truly understand that your time is indeed invaluable. So thank you once more. And also, we also like to show a deep appreciation to our panel of experts for taking out their invaluable time as well to lecture us through this process. Thank you once again. If you've got any follow-up questions, please kindly address it to us at media@commitbiz.com. We'll be more than happy to respond to your queries therein. Thank you once again, and thank you for attending this webinar with us. It's highly appreciated. Do have a nice day ahead.